Hey, Dan Passarelli here. What I get asked often about are short squeezes, and sometimes people aren't sure what they are. So I thought I'd take a couple minutes and just explain what they are and how they work. So people buy stocks, right? And when they buy them, the price of the stock goes up, and that is theoretically related to the value of the stock. But, the market isn't 100% efficient. No economist agrees with that these days. And sometimes stocks can be overpriced. Now, this is all, of course, a matter of opinion. Everyone acts on the information that they have, and no one really ends up with the exact, perfectly clear picture, especially since you can't predict the future. But when some people believe that a stock is very overvalued, what they'll do is they will borrow shares and then sell them and then hope to buy them back later to return them to their owner. Now, that is called short selling. This person doesn't actually call up their friend who owns the shares. This all happens in the back office of their brokerage firm. The brokerage firm, on their behalf, borrows the shares from one of their customers who owns it, who is willing to lend it out, and puts it into the account right at the moment when the short seller actually sells short those shares. And so that is the name of the game, to basically reverse the order of buy low, sell high. Instead, here we're selling high, hoping to buy low later. Now, here's what happens sometimes is that when big companies do this and they short a lot of the available shares out there, because remember, there's only so many shares that actually exist. The ones that are available for trading for any individual company is called the float. When more than, say, 15% of that float is shorted, that's kind of a lot and it's meaningful. And so when the stock starts going higher, the person who's short a lot of these shares has to buy them back. And they have to do this because they may be using leveraged money, which when you short a stock, you basically are by definition. And they have customers to answer to. And so the higher the stock goes, the more inclined they have to be to buy those shares back to prevent further losses. And that is called a short squeeze. And a lot of people look for them. I've got this screen up here. This is one that happened pretty recently in RXRX. And as you can see, it was a pretty low price stock. They had a pretty high number of their shares shorted. And once it started going higher, many people ended up buying calls in there, which forces the market maker who sells the calls to buy more shares of stock, forces the price even higher and even higher. And a pretty big profit can be made in a pretty short period of time with these short squeezes. That's why they're attractive. I hope that helps. This is Dan Passarelli. Trade smart.